Good evening, everyone. My name is Gregory Walter, and I'm the pastor here at Fountain Avenue United Methodist Church. And one of the most important things that's happening in this church is what you all are part of in this neighborhood. It has given a whole extra dose of energy and life and vitality to us here to watch the neighborhood take shape in all sorts of ways and to be a part of that revitalization. And we're glad you're here in the church. We hope you'll count on us as neighbors, strong neighbors, as a good anchor to what's happening all throughout the neighborhood. And glad especially you're here tonight. The point person from our church, the real person that makes it happen for us in powerful ways, is Sharon Polk. You all know Sharon Polk in all various ways that she works in this community. And I am thrilled to share church with her here as well. And now we'll have Sharon tell us about all this next.
I'd like to thank Brother Gregory for the introduction. We missed him last week. He was out of town. I am here serving in capacity as Executive Director of the Midtown Alliance of Neighbors. It's wonderful to see several of you who were here last week back again for some more information, and a couple of new faces as well. Thanks as well to a couple of our board members on the Midtown Alliance of Neighbors who have come and are with us this evening, and to several folks from the city who have come to offer their expertise and correct us when I manage to say something that's wrong, and offer up accurate information so that we all know what needs to be happening in the neighborhood. I wanted to start the session. This second session is how to pay for improving my home. How do you go about financing a rehabilitation project? But a good place to begin that is just with a couple of quick minutes of review of what we talked about in the last session. Inspectors are guided by codes. We talked in the first section about what the inspector will be looking for when he comes. The building inspector is guided by codes, primarily the International Property Maintenance Code, which lists out item by item everything on the inside and outside of your property which should be properly maintained. He's going to look for life and health safety issues. I threw up here just a couple of quick things. If there are problems with your electrical service that could cause fire, it could cause shock hazard, he's going to check out other life and health safety issues. This is just a placeholder of a furnace, but furnaces are sometimes quite dangerous if the carbon monoxide is leaking. And he's also going to look for property maintenance issues, and that's mostly what he's going to be spotting at houses around the neighborhood. Here we're seeing a lovely example of a deferred maintenance on some wood paint, some exterior paint, which is causing rot, and also some signs of maybe a roof leak on a chimney here that's damaged, a chimney inside. Interior, exterior, he's going to look at both. But an important thing to remember is that the inspectors aren't the beauty police. You might be sick and tired of the pink walls or the old cabinets, but as long as the paint is solidly adhered, the cabinets are solidly adhered, it's solidly attached to the wall, they're not falling off, that is not a maintenance issue. You might be sick of the shag carpet or the acoustic tile or the paneling that's been on the wall since the 70s. But if it's properly adhered, it's not a maintenance issue. So they're not the beauty police. The inspector's going to focus on things that will make your house safer and help your house to last longer. So in many ways, they're doing things that are improving all of our property values house by house. I would encourage any of you who weren't here last week or who had to leave early last week to pick up a copy of the 3-page handout, Inspections, Procedures, and Overview, which looks something like this. It'll offer a lot more details on what to expect. Specifically, it's going to outline when to expect and what to expect when the inspector comes, what the corrections notice will look like and the importance of planning once you get it, how to get the required permits and when to get follow-up inspections, and when fines might be levied. Now, in this outline of things, the real bulk of the work for most homeowners is once you get that corrections notice, what kind of planning are you going to do? Where do you go from there? And it's that couple of weeks right after you get the correction notice that you're really faced with a lot of work. It's a key time. there are two things that happen at the same time during that 2 or 3 week period. You've got to figure out what work you need to do, what order you want to do it in, and who's going to do the work for you. And at the same time, you have to figure out how you're going to pay for the work. And a lot of times those two things inform each other. The kind of money you can get together to pay for it might impact what order you're going to do it in, what you tackle first, who you're going to get to do it. The outline of this session focuses on financing, which is one of those two things. How are you going to pay for the work? And in some ways, I kind of wrestled with which of these two to talk about first. How do you put together a plan, or how do you pay for it? And I finally settled on, let's talk about paying for it first, because sometimes what really occupies our thoughts more than what needs to be done is, oh my gosh, how are we going to pay for it? And until you can begin to get some idea in your mind of some of the options for paying for the work that needs to be done, it's hard to settle down and think about how exactly you want to go about doing it. And so tonight our focus is on financing. Now, over the course of the evening, we're going to see and hear from several different speakers who are going to offer a variety of different kinds of approaches. Every person in this room, every person in this neighborhood is in a different position, both individually and financially, and with their house. Some houses are really pretty much up to code. There might just be a few minor maintenance things. Some houses may be close to code, but there may be 1 or 2 major projects. Everything else looks good. Some houses may need a lot of work overall, and depending on that situation and the financial situation of you as the homeowner, your options are going to be different. I wanted to start off this evening by inviting Dawn Falwell, who is a banker at BB&T. Dawn works, and you correct me if I'm wrong, Dawn works primarily with mortgage lending and does a wonderful job getting low and moderate income homeowners as well as homeowners across the spectrum into houses. But as somebody who's worked in the banking industry a long time, she has a very good understanding of what financing options are. What are the kinds of things that people need to have together if they're considering getting a loan? There are a few folks in the neighborhood who may be able to do everything they need to do just with some budgeting. And that includes both the inspections required things and those beauty things that aren't necessarily part of the corrections report, but if you're doing the work, you want to go ahead and make that kitchen look a little sparklier than it did before. So you put those two things together and you begin to think about, how is it that I want to finance this project? Later on, we'll be seeing a variety of programs that some are specific to folks in a certain income bracket, some are specific to folks who have a certain size project, some are specific to folks in a certain area. But hopefully there'll be something here that you can take away that will help you with financing the project that you have to do with your house. Dawn, I invite you to come up and speak. Thank you.
As Sharon said, I'm Dawn Falwell. I probably have more than 20 years in the financial/mortgage industry backed behind me now. I hate to think that I'm getting that old, but I am. And I would, in talking about this with Sharon, and I told her I don't really have any way to lay out anything to hand you to say, this is what you get, this is what you can get. Each of these situations will be unique. There will not be two that are the same. And at the same time, no borrowers are the same, or no clients are the same. Everybody's incomes, employment, housing needs are different. So it's not a one-size-fits-all type situation. I did bring some pamphlets from BB&T that talk about home equities, second mortgages, personal financing, and just kind of, it gives you an option or a list of what kind of products BB&T may offer in that situation as a lender. But I also always recommend that people check with their banks, who they have their relationships with. In today's environment in banking, relationships mean a lot. So you should always check out several sources, okay? Because it's not the same everywhere. But I have to think that most people that already own homes in the neighborhood are probably going to be looking at what we refer to home equity loans, which are second mortgages or home equity line of credits. And those vary by what you need to do. One thing that people often come in and talk to me and say, well, I need to do some improvements and I need to borrow some money. Okay, what kind of improvements do you need to do and how much do they cost? And most of the time they look at me and they go, well, I don't really know yet. We kind of need to know. Okay, it varies by what we're going to guide you to do. If you need a small amount of money, then definitely it may be more like a home equity loan, a second mortgage, or a small loan of that nature. Loans that I do are going to be your bigger types of loans where you're refinancing your entire house into one loan. You might pull some equity out of that mortgage to do your improvements in, if you have enough equity in the home to do that with based on its current condition and current appraised value. So there's a lot of ifs in that, and one thing that guide us to determine how best to approach your deal and what you're wanting to do is how much is it going to cost you. And once we kind of know that, then we look into the other things. What is the value of the house now as it sits today? Because if there's enough value in it as it sits today, then that leads you down a much easier path to obtain funds from a lending environment.
What's your loan to value?
In today's environment, most banks loan to value in what we would term as a cash out refinance is 80%. And they're not going to lend more than 80% of the appraised value. If you have a first mortgage and you're looking to do a home equity, then most likely it's going to be 80% of the appraised value less the first mortgage balance, and the remaining balance is what you can obtain through a second mortgage or a home equity. So there's very few lenders in today's environment that are going to exceed the 80% loan to values. And that's where...
How about reverse mortgage?
We don't do reverse mortgages. BB&T, one thing to understand about BB&T is we are a very conservative lender, and our corporate does not necessarily think reverse mortgages are a healthy thing for people. I must say I don't necessarily all the time agree with that. I think if you're interested in a reverse mortgage, you really have to research them and make sure you understand. Basically, a reverse mortgage does not give you equity out of the house. You understand that part of it?
Sure.
Okay. But it basically is buying your house from you over time. Mm-hmm. So instead of you making a mortgage payment, they are paying you. But they're also paying you less than what your house is worth.
But if you don't have anybody to leave it to, once you're gone,
I'm not against the theory at all. I'm not even against the theory for people who have children. If they need that money more than their children does, and it helps them gain a better living of life through whatever, then I'm not going to be the one to tell you that that's necessarily a bad thing for you. I'm just going to say that BB&T does not do that, but there are sources locally that do that. Okay, and that's an option. People, one thing is sometimes when I talk to people, we actually get down to the nuts and bones of it. They don't really need to borrow money. They have access to other sources of funds through other ways that may benefit them more than borrowing the money from a bank. Okay, I've done some just Google searching lately, and a couple of the government websites gave some options on how to do home improvements, and suggested several other ways besides borrowing money. And one is to go ahead and liquidate some stocks, borrow from 401ks. Don't always suggest you borrow from a 401k, but when you think about it, if you're borrowing your own money, it's cheap to borrow your own money. And people don't often think of that as a good source of money, but sometimes it may be, because it's cheap to borrow your own money, and it is technically your own money. So it gave a lot of different suggestions that as a lender we probably don't always sit down and talk to people about, because we do talk to them about loaning money, about them borrowing the money. But second mortgages come in a whole variety of different types of things. They can be line of credits, which means that we establish you a limit and you basically use this money, pay it back, reuse it. The payment terms on them are low, so you don't make a big payment on it. Right now, the interest rates are highly advantageous on that type of loan because they're extremely low, but the beware item is they're not always going to be that low. We are in a very, very low rate environment, but the chances of us staying in this low rate environment over a long term is not very likely.
But it would be a fixed.
Home equity line of credits are not fixed. They are variable because they work like a line, okay? So you're gonna draw them back and forth. But can you do other types of second mortgages, like fixed rate second mortgages? Yes, but they don't operate as lines. They operate as a lump sum of money. That's why it's always good to know what your project's gonna cost. And you can get that lump sum, you can borrow it over 5, 10, or 15 years on a fixed rate. And those rates in today's environment are also very advantageous. Okay. So, and those are probably, and I don't know, because I haven't really talked to a lot of people who are looking to rehab in here. I've done some home purchases in this neighborhood, but I don't think I've done, well, I have done one rehab in this neighborhood a few years ago. So the other aspect of it is something that needs extensive rehab is a full-blown construction loan. And that is something that would need, basically the house is probably not livable in today's environment if we're going to look at doing a full-blown construction loan to get it up into condition. That is a massive type of loan to do. It's costly. The fees on it are expensive. We only lend 75% of the value of the house, and that is the value based on the improvements being complete. So that's not the value as it sits today. That would be the value as if the improvements were complete. We call that a predicated appraisal. But basically in those situations, you probably have to have some of your own funds into the project as well. 75% may or may not get you done. Okay. And those, like I said, those types of loans are very expensive. The fees on them are high. Second mortgages, home equity lines, things like that, the fees are low. So they're not that expensive to do, and the rates are very good.
By fees on a loan, do you mean upfront points?
Home equities and second mortgages, yes, they have what we call an origination fee on them, which is a point, which is basically the fee on the loan. Refinance mortgages and construction loans, they don't necessarily have points, origination or discount points, but they have more fees in getting the loan done. Appraisals, credit reports, title searches, flood searches. They require title insurance, which is an insurance policy that backs your deeds. Any loan that goes into a fixed rate type, full 15, 30, 20, 30-year mortgage is going to require things like that. So the fees for a construction loan are much higher. We inspect in construction loan projects. So that means we're going out periodically, we're looking at these projects, we're making sure that what we're paying for is going into the deal. And we have a lot of say on releasing that money to you to pay for those things too. Like I said, a construction loan, to me, the house needs extensive rehab. And to get into that type of loan, I'm gonna have to think it's probably not livable today. So if the house is livable, you're probably looking more at a home equity or a second mortgage type situation to bring it up into code versus a full construction loan type environment. Does that kind of make sense? Maybe.
I understand it.
Okay. Okay. Just want to make sure. I'm on the
I
right
understand
track.
that it's very expensive.
Construction loans are. But
So you're paying all the money up front actually to the bank. So you might have a low interest rate loan, but it's going to cost you.
well, a construction loan is a loan that's set up for you to draw the money over a period of time to rehab this house.
Okay.
Okay?
Okay.
So it's not really set up as a fixed rate at that time.
Depending on point of construction, right?
And how much needs to be done. You know, the one construction that I did in this neighborhood a few years ago, and that project needed over $100,000 worth of work. And that was a huge project. That is definitely going to probably mitigate some type of construction loan. But I don't know. I mean, I really don't know what everybody's individual situations are to say that would be something. And if it does work out that somebody needs that type of construction loan, you definitely need to be shopping in between lenders and see whose construction loans are more flexible, I would say, okay? Because they all have different guidelines, and ours are very conservative. Ours are very strict. We're gonna watch that project and watch every penny that goes out and every penny that goes into it. There'll be times where we may say we're not making a draw. It's not had enough done on it to make a draw or something. So that's a little different situation. But second mortgages are a lot more flexible, because basically we're saying your house already has enough equity in it for you to perform the work that you need. Here's your money. Go do your work. So it's a little bit more flexible of an environment to do that. But everybody's situation will be different. Things that people need to be prepared for when you go in to talk to any lender is most likely that any lender's gonna want proof of income. So we wanna see what your income sources are. And not only that, we want you to prove it. So we want to see your pay stubs, your benefit statements, your W-2s, your tax returns. We want to see that information in today's environment. And that's somewhat of a change in the last few years. Not for me, for say in the type of loans that I do, but for our lenders in our offices that do the home equities and second mortgages, they never asked for income documentation before. But the government seems to think we made a lot of bad loans, and has gotten heavily involved in how we conduct our business. And unfortunately for the consumer, has some good points to the consumer, but on the other side of the consumer, they are dictating what we ask from you. And at the same time, we're required to do a whole lot more in the processing of our loans. That cost us more, and that cost is being transferred onto the consumer. And with the new banking regulation that was signed into law, it'll be interesting to see what's coming down the pike in the next 12 months. We've been through a lot of changes in the last 2 years. So it'll be interesting to see how the new regulation affects us, and how many more fees that adds on to the consumer. And I hate to say that from the banking side of it, but that is part of what we're going to be seeing as the time rolls down the road. But so on your side, as the person needing to rehab the house or make improvements to the house, you need to be prepared to furnish us that type of document. If you have not reviewed your credit, I would strongly suggest you do. And you can obtain your credit from, I think it's annualcreditreport.com is the correct website you're supposed to go. That is the website the government directs you to obtain your credit report. And I would suggest you all take a look at it. Credit guidelines are a lot tighter in today's environment than they were a few years ago. And if you need to do some cleanup, you want to do that prior to coming in to see the lenders and try to head that stuff off up front.
Is there a magic number that your credit score?
There is beginning to be a magic number for credit scores, and I always used to say, no, there is not a magic number for credit scores. But unfortunately, and as I said, I've been in the business a long time, and I said 15 years ago one of the worst things to ever happen to the mortgage industry was credit scores. It eliminated a lot of people from learning how to read people's credit, and now they just see a score. And behind every score, there's credit that goes into the score, and it's all, in my opinion, it's all about what is the credit in the score, what made the score what it is. I mean, I see scores that are 720, which is a great credit score, and they have one credit reference on their credit report. It's a bogus score. It's not telling me how they pay their bills. It's only one thing. But I also see scores that are in the low 600s, and their credit is basically good, but maybe they had a major medical issue and ended up having some medical collections and things on their file. That doesn't make them a bad credit risk, but the score would lead you to believe that it does. So in today's environment, and it's funny because I had to talk, well, I've got lots of friends, but I ended up talking to a few of my friends at a couple of the credit unions not too long ago to kind of see where they were setting, because used to, if I had somebody I really could not work with, if they had a relationship with a credit union, I could send them to one of the credit unions, and the credit union could probably work with them and help them out. Because credit unions were a lot more flexible than the banks are typically. But the magic score is becoming 620. So once you get to 620 and below, it's tough to get it done no matter what the circumstances are. And that seems to be running through the credit unions as well. So we are seeing the magic score in the industry become 620. And once that score gets to 620 and below, it's tough for us to lend on anything. It doesn't necessarily matter what type of loan it is, it's basically on anything. So to answer that question.
If folks are bringing in proof of income and they do have some significant savings, or they own some stocks, or they have a 401k that's sizable, do they bring in proof of that too? Does that impact how you see their stability or not?
Most second mortgage environments, and so let's kind of break it out. I am what you would call primarily a secondary market lender. So most of the loans that I do are going to be Freddie Mac, Fannie Mae quality loans. They're very in the box. I deal with the government programs, rural housing, FHA, that kind of stuff. But the loans that I do are very in the box. It's a very rigid, you can fit in the square or you don't fit in the square. And it's very hard to shave the corners or whatever to make it fit, okay? The retail environment, which does the second mortgages and those types of things, their box is not quite as square. And they don't necessarily ask to see that documentation. A lot of times, what I get irritated at the younger retail lenders is they want to hand somebody a personal financial statement. Well, heck, I can't even hardly fill out a personal financial statement. I've been in the financing world for over 20 years. They're complicated. They ask questions that people don't understand what they mean. I hate for somebody to hand somebody a personal financial statement and say, fill this out and bring it back to me. So what I would rather they do is sit down with you all and ask you what you have, what's in your bank accounts, your checking accounts, your IRAs, your 401ks, and gather that information from you. They do not typically ask for proof of that. But if we were actually doing a full-blown refinance of your residence, I would want proof of that, yes. I would want the statements. So it's different mechanics for what you're doing. And sometimes when we sit down and we look at what people have, and then sometimes I may lead them down a different way to get something done, depending on what their needs are and how much money they are looking at to borrow, because there are different ways and different avenues to do things. It's just a lot of times people don't think of what those things are.
Dawn? I know this will raise some eyebrows, but it's the main reason I came here. If the city of Paducah would scratch its back, I could easily scratch mine. When I came home from that ice storm last year, a tree I had been to City Hall and asked them why they didn't take down at least a half dozen times, lay right across my front porch roof. That thing leaked like, Lord, I don't remember when it rained that hard. Now, why isn't such as that done? And the sidewalks out in front of that house, I'm not bringing that thing here for pity. I'm here to tell you I'm not. So why isn't such as that done? Good Lord, I worked at Public Works once, and I got news for you. I walked many a mile with that old jackhammer. I certainly did.
Well, the good thing for me is I don't work for the city, so I don't have to answer that question. And I don't know what their situation is when you request tree removal and things from them, but I understand your situation.
4-man committee, Hart, that just tells them they don't have to pay anything they don't want to. And that leaves us hanging. It most certainly does. If we could be sure this city-county merger would fall through and they wouldn't just put 4 or 5 people there to vote on it and slam it through, we'd all be in that county. All of us, I'm telling you, that population would, bam, go through the ceiling.
Well, and I can understand your situation, but that's also, I think the city has a couple of people here, so I'll let them answer when it's their turn.
My question is, my sense is that the general activity in the neighborhood, the improvements it had made, even in other people's properties, has elevated the equity in everybody's property, hasn't it?
It has.
I mean, it makes
think
our
we're
properties
seeing-
more valuable.
I think we are seeing some signs of that. So yes, okay. When it comes to appraisals, it's all about timing. You know, sales age 6 months and definitely at 12 months. So you can do a spurt of sales in the neighborhood that definitely give you better comps for the appraisers to use to support those values. But if they're not continually happening, then once those sales age to 6 months and 12 months, then we're back in the same boat and we're having to go outside the neighborhood and look for supporting comps. And what gets you in trouble with underwriters on appraisals is the distances, you know, that you get into, and then it also depends on the appraisal, on the appraiser, and what type of comments that they feel free to write on there. And sometimes I just shake my head and go, well, you didn't really have to say that. You know? So, you know, but if we can keep continuing to get consistent sales, to keep that sales activity level so that every time we come in to get an appraisal, we have comparable sales in the last 6 to 12 months, then that will continue to support the values in the neighborhood, yes.
And that is important for somebody looking for a second mortgage because of what you were explaining to him
It's
earlier.
important to everybody. It's important from the people who say, okay, this is how much I owe on my first mortgage and I need X amount of money to do my improvements, so can I refinance my first mortgage, put that improvement money on top of it? The answer is yes, if you can appraise for enough, okay? And the same who says, well, you know, this is how much I owe on my first mortgage, but I only need $10,000 to do my improvements, so probably, maybe that's just a second mortgage environment. So, and it's equally as important to people buying homes in the neighborhood, because if you can't support that new sale with a comp, you're in the same boat.
Can I ask you a question? Because I know the appraising system baffles me. We've sold 10 houses in the last 12 months, if that's the cutoff point. We've sold more than that. Yet every time the appraiser, and these are not cheap homes, and every time the appraisers go out, their comps are outside of the Fountain Avenue neighborhood, and they're not pulling from this.
Well, one of the situations
Can you
is that
explain?
some of the homes are not on the what we call the MLS,
The
multiple
MLS.
listing sheet. Therefore, that is the appraiser's main source of data, is the multiple listing sheets. They're not on multiple listing sheets if they're not listed with realtors.
So each one of those to be counted would have to be on the MLS,
It
even
doesn't-
though they were done outside of the real estate.
Doesn't have to be on the MLS, but the appraiser has to know about it. And so it may be one of the things that the city needs to do is make up a comp sheet and make sure you're providing that data to the appraisers.
I've done that for
Yeah.
some, but then there are others that just go
Well,
out.
and here's the situation with appraisals in today's environment, and I don't think that the average everyday consumer understands how badly the lenders' hands have been slapped. And even good lenders, and I have to say, I work for one of the strongest banks in the company. We are one of the biggest banks that is reporting profits and has consecutively reported profits. We paid back our TARP money first and people don't understand, when we paid back our TARP money, we paid back in excess of TARP money to the government as well. You know, so I work for one of the strongest banks there is. I'm proud to work for BB&T. But every lender has had their hands slapped so severely, it is ridiculous, I have to say. So when we talk about appraisals, the appraisal environment has changed, where 2 years ago, I had my appraiser list and I rotated my appraisers. You came in, you sat down with me, we started your loan process, and I looked through my appraiser list and said, John Gregory's up, John Gregory gets this order. Glenn Miller's up, Glenn Miller gets this order. In today's environment, my appraiser list has been taken outside of my control. I cannot talk to these appraisers at all, period. So I don't have the luxury to call an appraiser and say, hey, this property's in Fountain Avenue, and you probably don't know, but there's 5 sales over there that are not on the multiple listing sheet. And I need you to call Charlie down at the city and get the information on those sales so that you can use them for comparables. We cannot do that in today's environment. And that's why you're seeing such wide swings in one, who is the appraiser going to be? Because one thing that we did finally to satisfy the FDIC and get them off our back is that it's still my same list of appraisers that I've used for 10 years. But it's a third-party company that rotates my list for me, and I can have no conversation with those appraisers. Okay. Smaller banks did not get that luxury, mainly because they can't afford to develop their own company to do this with. So they end up using companies, third-party companies that rotate, that they actually have appraisers that have signed up with them, okay? And so the smaller banks are a little worse off a lot of times than the big banks are, because they really have no control. And we've seen some of the small banks end up getting appraisers from 100 miles away coming in here to do an appraisal. Well, how ridiculous is that? We've got 20 appraisers that live in this town, you know? So that's what you're seeing. And unfortunately, since we can have no communication, you know, like I got an appraisal in yesterday, and it's a unique property. When I looked at it, this is not gonna work. But I can't call that appraiser and say this isn't gonna work. I have to call somebody else to have them call the appraiser and say this isn't gonna work, but here's a comp that we think you can use. Can you see if you can use it? So that's why you're seeing such wide swings, why you see people going outside of the neighborhood. Yeah. And then we have appraisers, you know, we had the VA loan last year that the appraiser didn't even ask the right questions. The appraiser was a complete train wreck. But unfortunately, a lot of it is what we have to deal with today. The fortunate side with us is that we are big enough that even though I can't talk to them direct, I can get somebody else to talk to the appraiser. And sometimes I call Charlie and tell him to call the appraiser.
Who makes the rule that you cannot talk to the appraiser?
The government made the rule.
That's your upper bank management?
No, the government made that rule and forced it down to the banks.
No wonder this gentleman is frustrated.
That rule, actually, it's called the Home Value Code Conduct, and it came out of a lawsuit that was in New York State, where the state of New York actually sued Freddie Mac, and I know y'all hear that name a lot. So what is Freddie Mac? Freddie Mac is not a bank, like somebody said in the paper the other day. It's not a bank. It's a GSA. They actually fund the money for the fixed rate loans, for the big fixed rate mortgages. But so the state of New York sued Freddie Mac for fraudulent values and said that the bankers and the real estate agents were influencing the value and inflating values. And the state won that lawsuit. Well, actually, they settled out of court. It never went to court. And based on that, they came back and developed the Home Value Code of Conduct. And that's where those rules came from.
But you and your bank are under the same regulations, so you can't go to another bank and expect to get any kind of different viewpoint.
Technically, yes, we should be under the same regulation. But each bank has a little bit of different tweak on it, okay? As well as if you're in a second mortgage environment, that's a little bit different than what I do, which is more in the box. And so it really just depends. Once a house has been stamped with value, with an appraisal, it is hard to go to another lender and change that value. I will say that.
It's hard to go to another appraiser and change it as well because of their conspiracies.
Some people say that. Appraisers are very, appraisers have a motto too. They say if you can't defend it, don't send it. Which means if they can't defend the value that they put on it, they're not going to send it to the lender. Because if they're audited or called up on the table on it, and we say, hey, this house was not worth what you appraised it to us at, They have to be able to substantiate and defend that value that they place on it. So yes, when an appraiser stamps a house with value, they're very adamant that that's the appraisal, whether I agree with it or in some cases the homeowner agrees with it as well.
Well, I won't run you off down this road of a tangent, but I can assure you there's no proof to that. And I proved it when I got an appraisal for a lot with a house on it, and what I'd asked for was a vacant lot. They didn't even go by the place to look at it. They presumed they knew what it was. And I want the challenge, and I can tell you 100%. So.
Well, I hope that appraiser lost their license because they wouldn't be working for us. But, you know, and it's definitely a lot more conservative environment than what we've been in the last couple of years. That, you know, I always say there's one thing that is for sure in this business is change.
When the homeowner is thinking about whether they need a loan or not and they come to you, it doesn't make any sense for them to come unless they have their income information together, right?
Yep.
What other things do they absolutely need to have in their hip pocket when they come if they want to have a good conversation?
You need to have your income. You may need to have some knowledge about your assets. I mean, most people know about their assets, but occasionally I have people that can't really tell me how much money they have in the bank. So you might have some knowledge about your assets. If you just want to talk, it's probably good for you to have some understanding of where you stand credit-wise. There are some situations where I can pull your credit, but there are some situations where I can't unless you are ready to move forward through the loan process. So you might want to understand what your credit standing is, especially if you're just wanting to fact find and talk, okay? And then have some knowledge about what's your cost. I mean, what are you looking at? You know, what's your mortgage balance now? What's your rate now? How many years do you have left? Those are standard questions that if you're talking to me that I'm going to ask, because that helps me determine maybe which direction we need to look at trying to do something for you in.
What kind of documentation or documents do you need for the purpose of that determined cost? If my property needs X number of dollars spent on it based on the write-up that the code enforcement officer gave me, what kind of documentation do you need on this? Is an estimate from a general contractor?
If I'm not
required?
doing a full-blown mega construction loan, I don't really need anything on it. I just need you to know what that number is, okay? And then based on that, what your mortgage balance is, or if you don't have a mortgage, or how much that is, then we're gonna be able to say, okay, based on this, maybe we ought to just do a refinance, and depending on your income, we may look at 15, 20, or 30 years, and everything's subject at that point to appraisal.
But suppose then my estimate was short and I don't get done. Now the code enforcement officer's going to tear my house down. How are you going to help me get out of that situation?
Then you're looking at refinancing again, so you need to make sure your estimates are good. And as I tell everybody, overestimating is better than underestimating, unless you've got cash you're sitting on that you're prepared to put into the project. You know, so always build a buffer in there for the unexpected. And anytime you're rehabbing a house, there is the unexpected. When you're tearing into old stuff, a lot of times you find more stuff. So, you know, so prepare for the unexpected. Okay, does that kind of answer your question?
Yes, ma'am.
All right. Any other questions? Well, okay, well, I hope I've given you enough to chew on, enough to think about, and I'm usually available. I'll be glad to chat with any of you for guidance if that's what you need.
Thank you very much for coming and talking tonight. Dawn.
You're welcome. So I left some pamphlets over there to just give you some general information. Okay.
I also have here a list that I put together. It's the banks and budgets list, just sort of a contact list, all of the different banks in the area. It's a name of a loan officer that you can call and talk to, along with a phone number, so you don't have to go delving through the phone book yourself. I think Dawn's suggestions were great. Start with your home bank, start with the folks you have a relationship with, but depending on the situation you're in, it might not hurt to get a second opinion, kind of like with doctors. And by the way, Dawn, I wanted to tell you how much I appreciate too, you're being willing to think beyond the box and say, look for other sources of money that you might have without having to go to a loan. Look at maybe selling some stocks or look at tapping into the 401k, because folks may have resources that may actually be easier to access or cheaper to access than bank loans.
People don't really realize that.
I've also included on here down at the bottom a couple of folks that you can contact if you need some help with budgeting. Dawn mentioned credit scores and the fact that your credit scores have to be in line if you're going to be going for a loan. A couple of folks I've put on here are local folks who are HUD certified counselors who work both with new home buyers and with current homeowners who are trying to stay in their homes. And they'll be glad to sit down with folks one-on-one and sort of look at the pieces and the problems and see how you can begin to work through those things so that you can get in a position where you would be available for a loan. I'm going to leave these over here on the table, and you all can either pass them as you will or pick them up at the end. One of the names that you will see listed on that sheet as being someone who does budgeting work is David Hargrove. David works over at the Purchase Area Housing Corporation in Mayfield. He works at the Purchase Area Housing Corporation in Mayfield. That's through the Purchase Area Development District. Thank you. My knowledge of Purchase Area Development District is that for the 8 purchase counties, they provide all kinds of programs, primarily for folks that are low and moderate income, that help them in a variety of ways. And this is just one program. You'll see David listed as one of those folks who can help with budgeting. I've actually invited him here tonight sort of to talk about a special loan program. A lot of those other bankers are listed. They can talk with you about home equity or second mortgages, those kinds of things. What David has to offer is a very workable and perhaps easier to access loan program for certain folks in certain income levels. So David, thank you.
Thank you. Like she said, I'm David Hargrove from the Purchase Area Housing Corporation as part of PAD. We run several different housing programs, and I did bring some brochures for you to look at. We have a homeless program, and we have rental units for the elderly and also just low income. And we run a lot of different other programs. What we mainly do is we apply for grants for city and county governments and also other nonprofits to help them do with housing projects. So that's our main focus. I also want to encourage you, if you haven't already done so, to sign the sign-in sheet. That helps us with our outreach. So when we're applying for grants, we can show that we've done outreach and that we've tried to work with the community to come up with ideas for projects. And also, it allows us to notify you about any upcoming projects we may have in this county. So I encourage you to sign in if you haven't already done so. Also on the other table, and Dawn had talked about construction loans, major construction loans, like if the house is barely livable. We're trying to do a community development block grant in McCracken County. And I brought some applications. I don't actually administer that program. But what that does is if your house is in very bad shape, instead of just calling me and trying to put a roof on your house or replace the windows, it actually, usually what we do, if you qualify for the program and you're accepted into it, we actually usually tear down the house and replace it with a similar house. And so you get actually a brand new house. Usually there's a loan attached to it of about $5,000 that you would pay out of pocket, which is pretty good for a brand new house. But the rest of the funds come from the Community Development Block Grant and funds from the state, such as home. So I mean, it's a really good program. I encourage you, if you need it, to take an application, or if you know somebody that needs it, to take an application. It doesn't have to be in Fountain Avenue. It's all in McCracken County. Again, we're just trying to get some applications together to present to the state to show a need. And once we get all those applications, then hopefully we'll be funded, and then the project will hopefully take off next year. So that's my boss really wanted me to bring those in. We're trying, if you do take an application, we're trying to get those done in the next 2 to 3 weeks, because we want this application in by November. So if you take one, make sure you get it filled out as quickly as possible and back to us. The other thing I was going to talk about today, and I won't take up too much time, is the rehab loans that we do. It's more of a home improvement loan. It's like Sharon said, we don't do the beauty things. We don't add rooms. We don't do paint. We don't do carpet. It's mainly for main things that your house may need, such as a roof, new windows, a central heating area unit, things like that. Our loans range from $1,000 to $10,000. You have to be the homeowner. You must be low income, so you must be 80%. Your household income must be below 80% of the median income for that family, and I don't have those numbers.
I was going to say, can I interrupt for just a minute? Because when I handed everybody the sort of outline for the session tonight, if you will flip on the bottom side of that, I knew that several different folks were going to be talking about programs that were connected to the area median income. And so here on this bottom, listed for a 1-person household, 2-person, 3-person, 4-person, and 5-person household are 30% of the area median income, 60%, 80%, and 120%. So the program that David's talking about right now is on the 80% line. So if you're at 80 or below, you would qualify for the program he's talking about right now.
And I'm so glad you brought that because I forgot to do it. The loan terms are usually from 5 to 10 years, kind of like what Dawn said, depending on your income and things like that. How we determine how much you can afford, and we try to address it over a 5 to 10 year period. The interest rate is a fixed rate of 5% for all loans. When you fill out an application, there is a $25 processing fee that's non-refundable, so it's just for us to pull a credit report and to process the loan. Kind of like what one of you gentlemen talked about, you must have a written estimate from a contractor. We accept one, but if you have more, that's more the merrier. And you also need to include a copy of your deed with your application because we do a title search. The cost of the title search and the recording fee are added to your loan amount because we will record a mortgage to hold against your deed. So if you don't repay the loan equals $1,000, you could be foreclosed upon, so just keep that in mind. Payments are typically made to the contractor after completion of the work. We can do a 50%, and 100%, but we prefer to do it at the end of the work if all possible. And we do come out and take pictures of the work after the work is completed. Unlike Dawn said, credit score it's not as important as it is at a bank. Just for an example, Sharon did send me somebody who had a very low credit score, and we did approve their loan. Their credit score was below 500, but they only had, and it's kind of like what Dawn said, there wasn't very much on there. There was one medical bill and one credit card payment that they had paid late a couple of times, but for the most part they paid it on time. But for whatever reason, that affected their score and made it below 500, and we went ahead and approved that loan. At the same time, I had somebody a couple of weeks ago that had almost the exact same credit score, but there was more things on her credit that brought it down to below 500. She had several bills, utility bills that hadn't been paid. They were pretty recent, so we didn't approve that one. So just because the credit scores are similar doesn't mean you'll get it approved. It just depends on what your overall picture is, and we do kind of look at that. And that's pretty much it as far as that rehab loan program goes. Does anybody have any questions?
Well, David, I wanted to thank you for coming because I wanted to begin to lay out for people and sort of help make people aware that depending on your income level, depending on where you are, there are some different kinds of options and some different places that you can turn. So where you might be able to be a little bit more flexible with a credit score than a bank, you might be a good place to turn for a certain kind of job.
So I didn't bring any of the rehab applications, but I did bring some business cards. So just pick up a business card, give me a call, and I'll be happy to mail you out with all the instructions that go with it. Okay. Any questions? All right. Thank you.
Next up on our line of discussion is Steve Urban, who is in charge of the planning department with the city of Paducah, and Charlie Doherty, who is over the Fountain Avenue area here, are going to be talking about a couple of different incentive programs that the city has. So if there is an income qualification, it probably won't be the same as what David had. So, and if there's a project size, it's probably a very different kind of project size than David's loan program could cover. And so it may well be that you or one of your neighbors is in a position to take advantage of one of the incentive programs that the city has available. Charlie, are you up first?
I'm up first. This is my first PowerPoint. My name is Charlie Doherty, sometimes known as Fountain Avenue Charlie. I'd like to thank y'all for asking me here. I'm going to talk about one of the incentive programs we have. See, I did it too. Okay. Which is technically called the Fountain Avenue Financial Construction Assistance Program, but it's the city incentive is what we refer to it. And it is set up primarily to target major rehabs. You can see by that first bullet that there's a 15% payment at the end of a project for projects that cost over $50,000. So it's not, it's a little bit bigger scope than what David talked about, the $1,000 to $10,000. These are for major projects where, and I'll show you some slides later on some of the ones that have been done in the neighborhood. Basically speaking, it's at the end of the project, the city will write you a check or pay you 15% of your project cost. It has to be, you have to pull a permit for it. There was some confusion last week when we talked that because there are Fountain Avenue fees, for permit fees, that you didn't have to pull a permit, but you do. And I'll get to this later, but it's a crucial number. When you go in, just like Dawn said, figure high, because what you tell the inspection department when you pull that permit is going to be your number. That's what we're going to work from.
And that's
we're going to
what
base that 15% on.
Oh, okay. And that's what you base it.
That's what we base the 15% on. So if you go a little high, and at the end, we look at the project and determine through the receipts and the documentation that you didn't quite spend that much, then we'll have to adjust it a little bit, but we won't go over that initially. Okay, and we also offer 10%. We went past the word to people that don't live in the neighborhood that the same deal applies to folks that live out of the neighborhood and come and buy a house and rehab. But again, it has to be over $50,000. This is just a copy of the ordinance. I highlighted that date of April 17, 2007, which is...
Excuse me, Charlie.
Sure.
Can you take advantage of this along with conjunction of another loan?
Sure. Yep.
Okay, so that
It's based on the project.
can be combined.
Well, this isn't a loan.
I know, but it's an amount of money that can work with the loan that you are applying for.
Right.
And I know of a person right now that could buy what he wants to buy if he knew about this.
Really? If he knew he could get the 15%.
And he wants the home, but he's been frustrated with
What here
putting the
in
deal
Fountain
together.
Avenue?
Yeah,
Wouldn't be 406, would it?
okay. All right, I'll pass the word. He's supposed to be here this evening, but he's not.
Okay.
He said it wouldn't be 406.
It's not 406 Fountain.
Okay.
He said, yeah, but okay. The commission passed this incentive program on April 17, 2007. Is that right? Or was I getting my dates? Anyway, I believe so. I'm going to keep pointing it at the screen all this whole time. I'm mentioning these dates and highlighting the dates because it gets a little confusing. On April 18th, down that light went down at the bottom, 2006, the ordinance was passed for the standards that we talked about last week, the codes. And some people have asked, well, if we start, we did a rehab project after that was announced and passed by the commission on the 18th, can we still get reimbursed? If you pulled a permit and did the work, you can. You'd have to have documentation and jump through all the hoops that we're going to lay out here in a minute, but that does work. It does follow through. One of the main things is you have to reside at the, it has to be primary residence. Okay? I knew somebody was here. I knew you would be here. You did work after this date, didn't you, on your house?
With me?
No, in the back. Didn't you? You did, didn't you? Yeah, I've got your name down somewhere, so we need to talk about that. Okay?
I've been improving my home since we bought it.
Right, but I know that you pulled a permit for it after this date, I'm pretty sure. Okay, anyway, again, 15% of the permitted cost of the improvement will be paid to the property owners upon the completion of the project. It's on the back end, it's not on the front. It's what you get reimbursed after the project is complete. It is a forgivable deferred payment loan. And it's only available to property owners who reside on the premises. It's their primary residence. A forgivable deferred payment loan is basically just that. It's forgiven, and the payments are deferred, which means you don't actually make them. Okay. And I'll get to that in a little bit more detail later. Okay.
Is there any kind of lien on the property when that happens?
Yes, we'll get to that. And again, this is going to the dates, and I'll just skip over this because it's not that. The other major thing is that it's capped at $20,000. So that's as high as it'll go. So if you have a $200,000 project, you won't get 15% of that. You get $20,000. Project cost, the trigger is $50,000 for it to even be eligible. And number 7, a forgivable deferred payment loan shall be tied to the issuance of a certificate of occupancy, which you get from the inspection department. And prior to any payment, an affidavit shall be executed by the homeowner setting out these following things. Now, affidavit sounds real fancy, but it's basically, I have copies of it here if you want to look at it later. It's basically a request for the payment being set up. And by signing this, you say the permit was obtained, okay? And again, that figure for the permit is what we're going to use for the 15%, to calculate the 15%, to make sure it covers all the work. You have to say that if you are residing there, that's your primary residence. C, that the project has been completed and a certificate of completion has been issued, and that's another little piece of paperwork. It's no big deal. I have copies of that too. That certificate of completion basically says that you've done the work, it's notarized, you recorded at the courthouse, and that makes everything official. All costs for materials and labors have been paid for, and no one can claim a mechanics or material man's lien against the subject property in accordance with KRS Chapter 276. I have lien waiver forms here. That's all they are. You give them to the general contractor, and they say basically that they paid their subs, they paid their suppliers. Nobody owes anybody money. It's all clear. Okay, so that's that in a nutshell. Any questions, just holler at me. Proof of expense. This is the big one. As you're doing your project, you need to keep track of your expenses. Be religious about this. Document it. Everything from receipts at Lowe's that you get to the contractor's draw forms or draw requests. Anything related to the project, but certain things are not allowed. The last couple I've had, people wanted to deduct power tools for it, and that's not allowed. Okay, anything like a refrigerator, generally not accepted. swimming pool, things like that, okay? These are permanent improvements to the property, okay? But you need that, I'll read this out, proof of expenditures including copies of delivery tickets and materials that are site-specific, because they'll have your address on there if you get lumber. We don't want to be paying, for lumber that goes to your neighbor. Anyway, copies of subcontractor statements showing satisfaction for their labor and materials furnished to the project, the lien waiver forms again. Copies of statements marked paid with checks, canceled checks are fine. At the end of this project, you will hand into the planning department, particularly myself, and I will go over all of these receipts. And I'll visit the project and go through and make sure everything's done and said it's done. And if everything's copacetic, then we'll do the certificate of completion. You'll sign the affidavit or the request stating that this has all been done, and we'll put in for a check. I had a question about the strings attached, and there are strings attached. It is a loan, so the forgivable deferred payment loan is 0% interest, evidenced by a promissory note payable to the city of Paducah and secured by a mortgage interest in favor of the city of Paducah. Okay, the city of Paducah will prepare a promissory note and mortgage to be recorded. I also have copies of those, and they're basic standard language. Oh, were you raising your hand or just?
I'm raising my hand, but I'm also scratching it because I got busy.
Okay, do you have questions?
Yeah. Is there any way to do it retroactively if you have receipts?
Okay, that's why I had those dates up. When did you do the work?
Huh?
When did you do the work?
Over the last 4 years.
Okay.
And part of it was done by the Alliance of Neighbors. And how do you count volunteer work in your own?
Yeah, that's tough. We would have to sit down and talk, okay? And I'd have to look at the project. But April 18th, 2006 is the magic date. Anything before that, you're just out of luck.
And so that's when I started.
Okay, well, that's good. But I need documentation, pictures, a lot of times we do, but I need receipts and old bank statements, checks, whatever. And also, some evidence that the work was what it was like before and what it's like after. We'll have to talk. Do you think it's over $50,000? That's the major.
Well, it depends on what you're counting. If you're counting the Midtown Alliance repair on the foundation, stuff on the bearing wall and stuff, and all the other stuff that I've had done since April 2006. If you're counting my labor,
I'll count whatever fair market value is of the labor done.
okay.
So, but the burden is on you to prove, to document.
I think her issue, Jordan's going to become more the permanent value.
Huh?
I think her issue is going to become more the permanent value.
Oh, okay. Did you pull a permit for
For the foundation?
the work that you're talking about?
Well, as Sharon, permit, we put in a request, right?
But you've done other work outside of that as well, right?
Yeah, well, the other stuff I had done didn't require permits.
Achievement point.
Huh?
Achievement point.
Yeah. No, that's a great question, and I can't answer it right standing here because I don't know what exactly you're talking about. It's a foundation work.
But I'm saying, can you do it retroactively?
And I said, yeah, I thought, yeah, you can fit from April 18, 2006
Right,
on.
but if you wanted to put in for it now, and you could document that, all the work back to then, can you do it retroactively?
As long as it was a permit.
I said, yeah, I thought I said yes, didn't I? As long as if you got a permit, or you can document the
that was the
work.
thing.
Well,
I mean,
I'll
you don't
have
have a permit for little jobs here and there, and every, finish one, move on to the next, and do a help, or, have somebody working with you.
Any person can.
I hired plumbers for one thing, for part of it, but it wasn't the kind of stuff that required permits.
plumbing permit. Did they fix a faucet, or did they redo your lines?
I'm sorry, I can't hear you.
I think we probably ought to get into this later, but my basic answer to it is yes, and especially if you pull the permit. It's based on the permitted value. That's why I stressed that earlier about, that's the number that we're gonna use. Because we have this problem. We've had people come in and say, well, I did $30,000, but then I added this and this, but I only pulled the permit for 30. Can I get the incentive? Well, it puts us in a rough spot because it's a lot of staff time to go and make sure that everything's done. But we are flexed. Well, I know you do that, but I'm just, I'm trying to work with you here.
I know.
Okay? And we've had this discussion a couple of years ago.
Yeah,
So,
but it was sort of left up in the air at that point.
beg your pardon?
It was sort of left up in the air at that point, and there was nothing mentioned about permits, as far as I remember.
Used to work. Permitted value.
Sometimes the contractor gets the permit.
And that works. Okay?
Now, lay out for them how this promissory note, because when you say forgivable deferred payment loan, it just sounds really scary. But really, it's nothing, as long as they stay in the house for 5 years.
Well, the goal is to keep people in for 5 years, okay? And the reason for that is we don't want people taking advantage of the 15%, which can be sizable, $100,000. You could walk away with a lot of money if you turn and flip that house. Right.
What did
So
they
we have
say?
strings tied to it. And if,
It has to be 50,000,
yes, ma'am.
remember.
Turn it around, Charlie, the bad end has to be facing you.
Okay.
There you go.
I don't understand that paragraph either. Or Sharon does, but I.
It's a 0% interest loan. It's,
I understand
okay?
that.
You don't pay any, and it's evidence, that's probably the bad word, with the promissory note and the mortgage. It just means we have strings tied.
If you live there for the 5 years, like yours, you don't ever make any payments on that, pay it back, so it doesn't matter what the interest is.
Right.
Oh,
And if I can get to the next slide.
It's free money if you live there for the 5 years.
Yeah.
No payments, no payback, no interest.
I'll get to it in a minute, but it's
Okay.
forgiven 20% each year.
Oh,
At the
okay.
date of the,
Another paragraph.
at the date of the certificate of occupancy.
Okay. This new word thing.
Yeah, this ain't the way I talk. Anyway, the mortgage is considered second, and sometimes it'll be the third position mortgage. And again, cap is at $20,000. You can't get more than that back, even if you spend $300,000. And this statement, the homeowner is to reside in the residence for a period of 5 years. If the homeowner moves, sells the property, and I'd add rents the property out, moves it, because that sometimes comes up, then the note is to be paid by a homeowner. Okay, at a sliding reduced rate in the following manner. Sale of property less than 1 year, you need 100%. You can hold it 11 months, 30 days, or 29 days, and you sell it, and still owe the full loan payment back with no interest. B, sale of property after 1 year but less than 2 years. And again, it's the year of the date of the certificate of occupancy, where the ordinance reads. So, 1 year, 11 months, 29 days, you still just get 1 year. But anyway, 2 years is 80%, sale of property after 2 years but less than 3 is 60, and so on, down to 0.
If you sell, I imagine then that payment comes out of your escrow at the closing of the sale. So it's automatically repaid at that point in time.
Right. Yeah, if we could get a clear title, that's it. Okay. And again, it's designed to assist the major rehab projects or new construction. And because this is the Fountain Avenue meeting, I really concentrated on the 15%, but it's also available at 10%. Developers can come in, take advantage of this incentive as long as they pass that 10% on to the home buyer. It doesn't go to the developer, it goes to the home buyer, because that's what we're looking to establish. So this is one that we've been doing over on North 16th, and you can tell this is a major rehab. But any structural repairs like this, mechanical upgrades, the wiring, plumbing, heating and air, roofs, insulation, plaster drywall repairs, flooring, permanent flooring. You can't buy an Oriental rug and put it in there and try to get 15% on it. It's been tried. Landscaping, window repairs and upgrades, doors, painting, soffits, porches, all of those other permanent improvements. And it's been a successful incentive so far. We've paid, I believe, over $250,000 out since it started. That many people have taken advantage of it. And here's some examples of the work. This is going on right now, again, on 330 North 16th. Right there. This is 1614 Park Avenue. We totally gutted that and replaced all the siding on that one. This is Dr. Shanks here on North 16th. Christos. It's Harlan Brazier's. 530 North 16th. This is 406 Fountain, around the corner. It's right next door. 620 Monroe. 17. These have all taken advantage of this city incentive. And any questions on it? Any more questions? Maybe? That's a good idea.
I'd like to say one thing, that this really becomes important. What we found is when the homeowner or someone actually starts talking to the bank, most of the banks are aware of the city's incentive package, that at the time that we finish up their project, that they're going to have a certain percentage of money coming in. So quite often that's actually worked in to their mortgage. Yes, that money is to the homeowner that they can use on a variety of things that they want, but they can also use that as that gap, that 80% or whatever, to make that mortgage actually work. So it can become very effective as you start to look at
Yeah, it was that Dawn was saying that the 80%.
Right, we were talking about 15 here.
And that 15 could really fill that gap in there.
I believe Charlie and Steve are going to trade out, and Steve's going to talk about a brand new program, some new upcoming things. Maybe.
Pending commission.
If, for those of you that don't know me, I'm Steve Irvin. I work in the City of Paducah Planning Department, and I am going to talk about a new program. I guess really the first thing I want to say is this program has not even really been forwarded onto the commission, but it is a program that we're looking at, the commission's aware of, but they haven't actually passed the ordinance. This program really is going to be based upon funding. This year, the Fountain Avenue project, we are still moving forward. We still have our 15% incentive program, but we don't quite have the funding to do a full-scale homeownership assistance program like I originally intended. Maybe next fiscal year, we'll get the funding to move a little bit further on this program, but I at least wanted to tell you all about it, that it's something that I think we may start this year, have a smaller pool of money and a few lesser number of applications that we'll be able to approve. But the program is basically intended to assist low to moderate households with rehabilitation grants. Now, we've been talking about loans up to this point. Now, this word grants is being thrown out. So that's a grant to help you with the rehabilitation project. As I said already, the program has not been adopted. This city commission action is required. So certainly I can draw up these plans, talk to the community, take it to the city commission, but ultimately it's going to be their decision if they want to fund the project or not. Program will be limited this year to funds available, as I said. There'll be an application process, and scoring will determine recipients. Structures shall be considered deficient or substandard if they're even going to qualify.
And to be considered deficient or substandard, there would just need to be a corrections notice issued, correct?
That's yet to be determined. And as I go through this, there's a lot of this information we're discussing now between ourselves and even with departments in the future. Some of these things are going to change, but these are just kind of my thoughts at this point. In order for a structure to be deficient, you may need a minimum of $30,000 worth of improvements.
program parameters may include, and once again, I put may up there because I'm not sure. Is it 20, is it 30, is it 40? What is that magic number? Applicants must earn under 120% of median income. If you remember before, we were talking about the 80% median income. This bumps it up a little bit to 120%. We're probably still going to have scoring criteria on the applications depending upon the need, but at least allow somebody that makes up to 120% of the median area income to fill out the application to see if they can get funded. It will be evaluated on need and overall completion of application. There's actually going to be a deadline date of applications for review on this program. The Urban Renewal Board will oversee the selection criteria. And for you, Urban Renewal, I'm not sure if you're all familiar with Urban Renewal, they're a board of citizens of Paducah that make decisions on purchasing and selling property in the city of Paducah, or in Fountain Avenue. This program will require third-party estimates. What I mean by that is that before the city would actually provide a grant, they will have to have an estimate from a contractor saying how much that project will be worth, or how much the project will cost. The program will only be available to existing homeowners. The last program we talked about, we had the possibility of developers or new families moving in. This program will only be available for people that live in Fountain Avenue at the time of the adoption of the ordinance. A maximum of 30,000 funds available per residence. That number could fluctuate. Obviously, if several projects were done at that amount, it won't be a lot of projects that actually get done.
Do you have a conflict there because it says it needs a median of 30,000 and you can't go over 30,000, so your project has to be right on the button at 30,000.
No, a minimum of 30,000 worth of improvements to even qualify, and then down there says a maximum of 30,000 funds. So a minimum of 10,000, so basically it's 33%.
Get to that next button.
A minimum of 10,000 funds available per residence. So, and once again, we're playing with these numbers.
So, I apologize.
That's right. Funds shall not exceed 1/3 of homeowner contributions. Eligible improvements must be permanent. Windows, roofs, electrical, heat, that type of thing.
So the homeowner has to contribute 1/3 of the funds?
2/3.
2/3. Oh, forget that one. Okay.
But what
Next.
You mean, so if they're gonna give you 1/3 of the value of your project, you're not gonna take it?
But I don't have the 2/3. I have
What-
zilch.
this program really is,
Oh, no.
if it's approved, it's a step up. We were talking about 15% at 50,000. That has been successful.
Right.
Now we're talking about a project that if it is a $30,000 project, the city might come with 33% of the project.
Well, that's great for a lot of people.
I understand, but
Will that be cumulative or retroactive? The same question is.
no, will not. No, there will be an application process. It will be only for the time of the adoption of the ordinance.
So if you put in, let's just say you put in 30,000 already, but it needs another 10,000.
The way it's written right now, it will not apply. It's only from projects from this point forward.
So,
That's kind of an overview of that program. I would like to continue to refine that, bring it to the commission this year. It may be that we only accept a couple of applications this year for that program. And next year, maybe it's a few more depending upon the funds. But at least I'd like to start to get through the application process over this next fiscal year so we have a better understanding of how it's going to work. Last year we did.
How far along are you in developing the criteria for this loan? Because you say this is not ready yet and has not been approved. How about the criteria for qualifying for this? Are you working on that?
The ordinance has been drafted. It has not been reviewed internally by all our different departments. It has not been reviewed by our attorneys, and it has not been sent to commission. I would say probably in the next 60 days or so, we'll start to do something.
All right.
But as I said, the funding this year is very low. I mean, if we do accept applications, there will be just a few that will be accepted this year. In this last year, as many of you have seen, there was quite a few homes that were constructed as part of a home application. And really, that's where a homeowner is able to, for the most part new, but there was some rehabs also, is able to get a mortgage. And in the state of Kentucky, as well as the city's incentive program, brought the cost of that house down by upwards of $40,000, $45,000 to make the house affordable to a low amount of income family. It was very successful. We have sold all of our new construction, and we're contemplating doing another home application. We would not do another home application until we still have 2 houses left, one on Park Avenue, 1614 Park, and one on Harrison. Those 2 houses have to sell before we can move forward. If we decide to do another home application, a couple things would happen. One, it would be we would have a totally new design of houses that we would have a local design firm design. And number 2, we would sit down and have discussions about what exactly it is we want to accomplish. Do we want to do new construction, which obviously does encourage either existing homeowners in the neighborhood to move in or people from outside the neighborhood to move in, or do we want to use some of that to help existing homeowners within the neighborhood? And I know Sharon and I have had those discussions, and we will continue to have those. So that's down the road. I'm kind of leaning towards it at this point, especially if we're talking about helping existing homeowners, but that's something we're certainly considering. This is just showing the lot at 622, and then of course the house that you see on at the bottom.
Thank you very much, Steve.
Thank you. Any questions before? Yes, sir.
These new homes that they're working on is the one that you showed where they did the extensive direct work and then that duplex or something.
3031, 333 North 16th, yes.
All right. Are they going to complete them homes?
Sir, that was a program that we decided to do something a little bit different. It's called an exterior rehab program, where we actually took 2 houses and we got contractors to actually do only exterior renovations, including foundation, windows, roofs, fix them from the outside. And now, actually, in the paper last week, we're accepting proposals over the next several weeks for someone to come in, purchase those houses from the city, and then do what they want to the interior of the structures.
Okay.
The house across the street was owned by Urban Renewal. That house was transferred to a developer that is rehabbing it into townhomes that will turn around and sell that to private individuals.
Okay. What, the ones that you've worked on there, the first ones you were talking about, what are they going to sell?
When the city takes proposals, I think we put a minimum on those of $10,000, Charlie?
Well, we discussed 10 and 20.
Yeah. This Urban
Well, that's
Renewal,
what I was wondering about, how much work, how much it costs for you to have that
Well, we put about 35, 40
into the house
so they're
already.
finished. Yeah.
So you're going to take
less than it.
No, but-
half of what?
well, we don't know that.
Bidding on.
Yeah,
Hopefully it'll go
we'll
up.
take proposals, so
All
we
right.
don't know.
Yeah, we don't know.
Okay, so if a person then buys that home
Mhm.
and they put, say, $80,000 more into that house, and then they get that grant money back,
Mhm.
are they gonna get it on what you put in there too, or are they just gonna get it on the money they put in?
It's only on the money that they put in, the permanent value that they,
However-
talk about the 10%.
The 2 that you're talking about are also, we're trying to get and take advantage of the historic estate tax credit. So we've done things historically to the outside that complied with their regulations, and hopefully we can pass that on to a home buyer. And if they do the inside, which is a lot more lenient than the exterior, if they follow along with that, then they can qualify at 20%. I don't know, Sharon, what is it, you do 20 or 30?
It's up to 30%. I'm going to talk about that in a little bit.
Yeah, so that's another incentive there that they would get. And that would be 30% of the entire project. That would include the city. All right? That's the theory. That's what we're shooting for.
I want to thank Steve and Charlie both for coming and talking, and particularly Steve for being willing to lay out some brand new programs that are under consideration so that you all can see that the city's really thinking creatively, at least from my perspective. It seems that they're thinking creatively about how to help a broader spectrum of folks in the neighborhood who are in different kinds of financial situations. And I really think that the homeowner rehabilitation program that Steve sort of began to outline the parameters for could be very helpful for lots of middle income working class folks in the neighborhood. This last program that Steve mentioned is kind of connected to the first thing that I wanted to talk about just a little bit, which is a program that Midtown Alliance of Neighbors is going to be tapping into. I wanted to say that this home application that they're sending off an application for, the application is to the Kentucky Housing Corporation. The Kentucky Housing Corporation has a variety of programs around the state that are intended to help low and moderate income people get into houses as first-time homeowners and to stay in houses as successful homeowners. And through the Kentucky Housing Corporation, they have several different programs and several different ways that they go about helping folks. The city has used one pool of money in a certain way in the past, and they're considering how they want to use that pool of money in 2011 once they're done with their current program. There's another program that the Kentucky Housing Corporation runs that is actually more appropriate for the Midtown Alliance of Neighbors, which, as you all know, is a very small, relatively new nonprofit. We don't have the track record of producing housing that somebody like the city of Paducah or the Purchase Area Development District has. And so the Kentucky Housing Corporation has a pool that was sort of created for small organizations getting their feet wet in producing housing. It's called the GAP Pool. Here's how GAP Pool generally works. For families with a gross income of 60% of the AMI, the area median income or less. So this program, which we intend to tap into, could be used by folks who are at that 60% level or less. The home must need at least $10,000 worth of work, which is not hard to come up with, really, right? The total project cost per house can be no more than $40,000. That's the maximum set for this particular grant pool. If the family has to sell the house within 5 years, some of the sale price will have to be used to repay KHC a portion of the dollars that they put into the project. Now, the Midtown Alliance of Neighbors hopes to help 2 or 3 homeowners through this program by the end of next summer. We're still very much in the exploratory stage of this. We intend to give priority to households with a gross income of 30% AMI or less, and to elderly and disabled households. But we can accept applications from folks up to 60% of AMI. But we want to make sure that we're helping the folks that have the most critical need. Folks who are least likely to have other assets that they can put into their homes. The folks who are least likely to be able to walk into a bank and have something that they can leverage against in order to get a loan. And so we'll be taking applications from anybody who can qualify and prioritizing those and looking to help elderly and disabled households probably as a priority. You all should look for us to have applications out by late August or September. So we'll be beginning to get together the names of folks who think that they could qualify for this, and then we'll be working with those people to prioritize who we would help first, second, and third, and the kinds of work that we can manage through the program. Y'all have any questions about that? Okie dokie.
Yeah, so it is a grant, but it has to be repaid if you don't stay 5 years from the time you get the funds.
That's exactly right. And in a lot of ways, it's very similar to what Charlie was laying out a minute ago, where if you stay in the house for 5 years, the money that's been put into the house, you've lived there, it's yours, the house is yours, go and do what you want with it. But we put $40,000 of KHC's money into the house. KHC doesn't want you as the homeowner to go out then and sell the house that was previously worth $10,000 for $50,000, and the value that they put into helping that low-income family has dissipated to somebody else. And so what they do is in the first year, they would capture from the sale price the full 100%. In the second year, they would capture 80% from the sale price. They would capture 60, 40, 20, down to in the fifth year, it would be all the homeowner's sale price to keep if they sold it. That make sense? A couple of last things that I want to talk about just a little bit are a couple of different tax credit possibilities. We're talking about much smaller ways to help, but you know, a penny saved is a penny earned, right? You all may have heard about some of the federal tax credit programs for consumer energy efficiency. I pulled this directly from the Energy Star website, which is part of the government. And I have the full page right here. You guys are welcome to take it home and peruse it. And if you do online stuff at all, I welcome you to get on and look. They have 3 different kinds of tax credit programs that they have going on for improvements to your home that would increase its energy efficiency. One of those, and I'm sorry this writing turned out so small, but one of those is the one that people have probably heard about the most. It's this top one right here, which is through December 31st of this year, unless they decide to extend it again, which they have done before. And it gives you back 30% of what you put into any of these cost-saving features that would include a biomass stove, a HVAC unit, a new heat, ventilation, and air conditioning unit, insulation, roofs being either metal or asphalt roofs, water heaters, and doors and windows. So if you're installing things that are going to improve your home's energy efficiency, you can get back up to $1,500. That is 30% of the cost of installing any of those items. These other 2 that are down here, you don't see people using quite as often, but if you really wanted to look at making your house energy efficient, these are kinds of things, and these are much longer programs. They last through 2016. And it's talking about installing a geothermal heat pump or a small wind turbine or solar energy system or a fuel cell. And I had no idea what a fuel cell was. So if you go online and you click on the little arrow by fuel cell, it will define for you what a fuel cell is. So you all may discover and become greener than you ever imagined that you would be. You might be inspired to install some of these more complex energy saving things. I'm going to put this in the same pile over here so we'll collect at the
So
end.
you knew what a biomass stove was?
I am just guessing that the
Oh, okay.
biomass stove is like
I
a
was gonna
corn
be so
burner.
impressed.
But I could be really, really wrong. And my husband was checking into corn burners for a while, so there are probably other options. Yes, Mindy?
This is a tax credit. If you don't owe taxes, you just get the money back.
Oh,
It's
you are
every
so smart, Mindy. Here's the 2 details. Oh, and actually, I wrote the headline saying 2, and then I realized there were 3, so let's just make it 3 details about the credit. And this is that top credit, the one for changing out your heat and air, improving your insulation, changing your roof, your water heater, your windows and doors. This is the one most people are going to be looking at taking. Number 1, you can only claim one $1,500 credit on about $5,000 worth of new equipment. That's the 30%. Not separate credits for each category. So you can't get $1,500 for $5,000 worth of windows and $1,500 for $5,000 worth of new roof. You can get $1,500 worth of credit total if you make the improvements before the end of this year. You must make sure that the product you're installing is qualified for the credit. Not every product with an Energy Star label is. Just because the little stars on there doesn't mean it qualifies. Get on their website, has a whole list of facts if you're interested in finding out more. And number 3, to your question, Mindy, you must owe and file federal income taxes in order to claim the credit. If you don't have any tax liability, if you don't own any taxes, you can't claim this credit.
Does that mean that you have to be paying more than $1,500 in taxes?
That's exactly right, pretty much.
You get all of
And
it. If you paid $900, you could get $900.
you could get the full $900 back, yeah. Whatever you're paying in taxes this year, you could get that back.
You might, I don't know, could it?
It does
be-
not have a carry
It doesn't
forward
carry forward.
component to it,
Is that
no.
just for this year? Like I've already done a lot of that.
The tax credit program is for 2009 and 2010. So if you did that work during the 2009-2010 year and you installed the right quality of equipment and you have the receipts for it, it could be eligible for the tax credit. If you did it in 2009, you would have needed to claim it on your 2009 taxes. If you did it in 2010, you need to claim it on your 2010 taxes. Just one of those little bit of save a penny, earn a penny things. Now, last program of the night is a different kind of tax credit. It has the potential to be really worth a lot more to the homeowner. This is a state tax credit, and I'm just going to read with you so that we get through it. This is a state tax credit for historic rehabilitation of houses. If you complete a certified rehab project on your home, you can get back up to 30% of the money you spend in fixing up your historic home.
So that's being a historic district.
Yep, I'm going to get to that on the next screen so we can get that laid out. Now, it isn't up to 30% credit because the state has a $5 million pool each year. If they get requests for credits totaling more than that amount in a year, they divide it between each applicant. And just as a really practical example, this year was the last year with a $3 million cap. So next year they have a lot more money to divvy between folks, right? It's gone from $3 million to $5 million. But in this $3 million cap year, homeowner applicants were allotted about a 20% credit. They didn't have enough, they had too many projects to give them the full 30%. They got about a 20% credit. So somebody spending $20,000 on their home would have earned about $4,000 back.
But again, you have to be paying taxes.
Let's get to that in just a minute, okay? Because this is a little bit different than that federal program. The money comes as a credit applied to your state tax bill. And starting this year, it's fully refundable. Fully refundable is one of those glorious accounting terms that means absolutely nothing to the rest of us. But to put it into lay language, that means if you qualified for and were allotted a tax credit of that $4,000 in 2010, you would note that on your state tax return for the year and get that full amount back, even if you owed less than that amount in state taxes this year. If you do file a state tax form, even if you don't owe taxes because you're retired and your income's not high enough that you owe state taxes, it is fully refundable and you would get back that full amount in this first year. You don't have to earn or have paid that, owe that amount in tax in order to get it back. So that's a difference between that.
How do you have to qualify as an historic rehab?
Oh, what a nice leading question, thank you. The goal of the state historic rehab tax credit is this, and understanding the goal helps you to understand what drives the program and what they want out of it. The goal is to encourage the owners of historic homes to return or keep them in good repair so that the homes and their neighborhoods continue to make our communities interesting, unique places to live. And that kind of fits in with Fountain Avenue, right? Folks like the unique, different feel of what was here. In meeting that goal, repairs should be done in a way that respect the existing original design and materials in the home. That's the existing, what's still there should be respected. The Kentucky Heritage Council is the state agency that's been tasked with making sure that this happens. So they're the ones that certify projects. Now, to qualify, your home must be located in a National Register district. About a third of the Fountain Avenue revitalization area is currently in a National Register district. I don't know if many of you all are good map readers or not, but over here's Jefferson Street, over here's Park Avenue, here's 13th Street, and everybody recognizes Lane Park right here. And so what happens if you live, the line runs right down the middle of Madison Street. If you live on the Broadway side of Madison Street, if you live on either side of Monroe, if you live in the 200 or 300 block of Harahan or North 16th or Fountain Avenue, your house is in a current National Register district. That happens to be the Jefferson Street National District, which was put into place back in 1978. And their real goal then was, let's get those big pretty houses on Jefferson Street on the National Register. Well, they just couldn't help themselves, and they kind of jogged over and picked up the park for a couple of blocks. And so they just picked up a couple of blocks. The truth is that most of the rest of this neighborhood could be included in an expanded National Register district if that was something we wanted to undertake. And this is an aside, it's not really part of the presentation, but I would like to say, a lot of folks have the notion that being in a National Register district prohibits you from doing things with your house. That is not true. There are houses that are torn down in National Register districts all the time. There are houses that are remodeled in amazingly inappropriate ways in National Register districts all the time. The federal government doesn't have any oversight in what you do to a house that's in a National Register district. What they do is they provide the carrot. They provide incentives for you to do it right. They don't offer a stick to beat you over the head and keep you from doing things. You know who wields the stick? The local Historic and Architectural Review Commission. All of the kinds of rules that say you need to get your paint color approved. You need to make sure your windows are, if you're going to replace the windows, they're within this. You shouldn't brick up the front of that frame house. Those are things that go through the local Historic Architectural Review Commission. And interestingly enough, in the Fountain Avenue Revitalization Program, we all know that there are design guidelines for the entire neighborhood. Everybody has to meet certain standards on the exterior of their homes, right? And so everybody here really is getting a little bit of local oversight on the exterior of their homes, but only about a third of the neighborhood actually gets the benefit of the carrot of being in the National Register district. It could be expanded if everybody understood that that expansion was worthwhile and could be a benefit and not be a hindrance.
And there are exceptions because the shotgun house was vinyl siding was put on a brick house. So there are exceptions.
That may have been done before the design guidelines were in
That
place.
was done last year.
Vinyl siding's allowed.
Yeah, it
I
is.
said vinyl siding's allowed in Fountain Avenue.
For homeowners, yeah, it is.
If you own your home, it's just city-owned properties that you get from urban renewal that you can't put lots on.
Not the whole project guidelines for the Fountain Avenue neighborhood said you can't put vinyl siding on.
No, read no.
And that does raise a good point. Next week, when we talk about developing a rehabilitation plan, Josh Summers from the Planning Department, who deals with Historic and Architectural Review Commission, will be here to talk a little bit about what they do. I will try to have for you guys some copies of the design guidelines, and those are available to anybody who goes online. If you just type in City of Paducah, you'll get to the city's website, and you can, a little bit of clicking around, you can find those design guidelines and look at them and see what they look like if you're planning exterior changes to your house. Now, I want us to get back to the state historic rehabilitation tax credit, because what the reviewers at the state level look for and what local design guidelines permit are not always exactly the same thing. In many cases they are, but they're not always exactly the same thing. Have a couple things I want us to walk through before we get to that point. If you live Madison, Monroe, in that area going over toward Jefferson, this can apply to you now. If we expanded the district boundary, it could apply to homes outside as well. There are other things that must happen in order for a house to qualify. To qualify, your home must be a contributing part of the National Register district. And what makes it contributing? In general, the house must be at least 50 years old. There are a few houses that were infilled in the neighborhood in the 70s, would not be contributing to the neighborhood. And the house should not be radically changed from its historic appearance. within a district like this, it's not quite as strict as it is if you have a singly listed house. But you should be able to, driving down the street, recognize the house for what it was about the time it was built. To qualify, your home rehab project must expend at least $20,000 over a period of 2 years or less. If you want to spend your $20,000 really quickly, you can. But if you're doing some of the work yourself and it's a 24-month that you're expending for the project, it can take up to 2 years. That is at least $20,000. The upper cap on it is so high, I don't even know what the project amount would be. It would have to be sort of in that $250,000 range to max out on the top credit that you could get. All of the expenses for permanent improvements in your home are eligible for the credit. Expenses for new additions, because that's not in the historic part of your house, right? So if you're adding on a sun porch, expenses for yard work, including sidewalks and new fences, are not eligible for the credit. Remember, the goal of this program has to do with the historic house and maintaining. You're going to ask about historic garages, aren't you?
Carriage house, yeah, it used to be the carriage house.
If you can make a case, and your house is a really good example of that, if you can make the case that your outbuilding is a historically significant structure, sure. But if you have a garage that was thrown up in the 70s and has, vinyl siding on it, not a historic structure. For a more complete list of eligible expenses, you can go online at www.heritage.ky.gov. And I do have a handout on this as well. So if you want to take anything away with you, we'll have that at the end of the session as well. Now, in order to qualify, your project must be certified by submitting a 3-part application to the Kentucky Heritage Council. In the first part, you really just explain to them that your house is a contributing part of the neighborhood. You send them, there are the 2 pages of the application. Some photos and a little sketch map of your house. And these are before photos. Here's what my house looked like before I began working on it. And over here on the second page, see those blank spaces? You put a little description in of what your house looks like and of what makes it historically interesting. I've done a lot of this stuff over the past few years. It's not hard for me to figure out what makes your house historically interesting. I'm available for opinion, consultation, advice. If it's something you think you might be interested in, I'm glad to help you through the process. By the way, that house that you see there is my house, a little further out Jefferson Street. My husband and I did take advantage of the state historic tax credit right after it was put into place for work that we did on our house during 2005 and 2006. And so I've actually been through the process, and I've got to tell you, it's really not that painful. Part 2 is probably the most involved part of the application, because that's the part where you lay out for those folks at the Kentucky Heritage Council what you're planning on doing in the house. Over here on the first page, and it's so tiny you probably can't see, but do you know how everybody's been beating the drum tonight about having a sense of what the cost of the project is going to be in mind before you begin? That may come from one single general contractor. It may come from several subcontractors, along with your knowledgeable sense of what you're going to put into it. But you've got to have some estimate of what the work is going to cost. And then the real meat of this part 2 is you go part by part. Literally, can you see there where it says windows, interior walls, doors? They did this just to kind of get you started, because what you do is you describe, well, here's what my windows are like now. Original 1927 double hung windows, 3/1, peeling paint, some wood deterioration. And on this side, here's what I plan to do with them.
Is this for work that you're planning on doing, not for work you've already done?
Another excellent question. Ideally, it's for work that you're planning on doing. In practice, it could be for work that you've done going back for a period of up to 2 years, because remember, your total clock for a project is only 2 years. So you can go backwards and do work you've already done, but you need to have taken really good before photos of that work that's already completed, because part 1 and part 2 require that they see what it looked like before you did the work. And so if you have good documentation of that before, you can actually go back and pick up the value of some work you've already done. If you don't have that before documentation, there's no way to show what was there before, and there's no way to go back and capture that.
The exterior, but not too much on the interior.
So over here you would explain, here's what it is I'm planning on doing with the windows. Scrape and paint, replace deteriorated wood where necessary, glaze, and apply 2 top coats. And whatever element in your house you're going to work on, you're just going to put a description of what's there now and what you're planning on doing. And they're going to look at it and they're going to say, yeah, this seems to be in keeping with the historic character of the house, not destroying things. Or they're going to say, this is kind of worrying me. You're going to lose something that makes your house what it is if you do the work this way. Here's some general do's and don'ts, because in a lot of ways, sometimes people hear historic preservation and they think, oh no, I couldn't do that. They want me to lock my house in the way it was in 1925, and I can't do that. It's a lot more liberal than that, okay? They fully expect you to make structural repairs if needed. What they want is for you to have a fully functioning, livable 2010 house that respects its origins back in 1920 or 1910 or 1890. So make the structural repairs if needed. Please update the electrical, plumbing, and HVAC systems if needed. Add insulation and storm windows if needed. Repair or replace walls or floors that are damaged with similar materials. Oh, and by the way, a lot of times people think too that this means that if the walls were plastered, you have to get somebody who's real skilled to come back with plaster. It does not necessarily mean that. If you just have a little bit of work that needs to be done, the cheapest and easiest way to do it might be to fix the little bit of plaster. But if you have a whole wall that's crumbling down because of rain or water, they will allow you to replace with drywall. Patch sand and paint previously painted surfaces. They don't care about the color. That's the local folks to care about on the exterior only. Tuck point the brick if it needs it. Keep and fix the decorative trim work, doors, and other elements. A lot of times it's that decorative trim work, doors, and other elements that make your house what it is. Make it a cute 1920s bungalow or make it a Victorian kind of house. In general, update your kitchen and bath if needed and desired. You don't have to be stuck with the bathroom from the 1920s. You can update it. Or worse yet, the bathroom from the 1970s, right? You can update that update. They do have a few things that they're kind of touchy about, and here are the biggies, okay? Don't paint unpainted brick, particularly the whole house. Don't replace original windows that are in repairable condition. There are cases where it's perfectly acceptable to replace the original windows, but only if they're falling apart, totally deteriorated. If they're repairable, they want you to try to keep it because it's part of the original fabric of the house. Don't replace or cover original siding with vinyl. And don't totally gut and alter the layout.
Beg your pardon.
Yeah.
But that vinyl siding, like I was about paint once a while ago. What people got against that? They sell it, don't they?
They do sell it. The real issue that the historical folks, and remember this is their focus, the issue they have is that it covers up the older original material, which has a better feel to it.
Well, that's the reason I painted my house when I used to paint it.
Yeah. And there really are some possible cases where a house that has existing vinyl siding over, if it's well applied and if the exterior trim details, other details haven't been changed or covered up, where the vinyl could be left in place and you could address other needs in the house with a $20,000 project and still have it qualify. That is possible. And here's part 3. That's the end part. You've done the work. It's all done. You send them a set of after pictures. You send them before, then you send them a set of after pictures. And literally, it's it's 2 pages altogether, but on 1 page you list out the costs of what you put in the house. You keep the receipts in your file at home in case they ever come down and audit you, but you do not have to send to them a copy of every receipt for every expenditure that you put into the project. So, any questions about, and I would like to say that, and I said this before, but I'd like to reiterate it, this is a very attractive kind of program for folks who qualify in this neighborhood because you're already in a historic neighborhood, you're already doing a lot of things right anyway, and so to be able to walk in with $50,000 worth of work and to get back in the following tax year $15,000, $20,000 is really a pretty nice deal. I am more than happy to help anybody with this. If they're even thinking about considering, I'd be glad to answer questions, point you in right directions on it.
Is that state tax credit subject to federal income tax?
That's an excellent question. I don't know. I'll have to find that out. I'll find out. I'll email you, I'll let you know.
Thank you.
Uh-huh.
Cause she owes somebody some money.
Did they send you a 1099?
Really?
Well, that brings us to the end of several different, you can see there's quite a variety of different kinds of ways we tried to bring together tonight to help you think about ways to finance some of the work that might need to be done at your house. I hope that some of these touched and might be helpful to you in some ways. Please grab before you leave, and I'll put the 3rd sheet over there too, grab the handouts before you leave. There are also handouts for those of you who did not get them about inspections over here. Don't forget, both Dawn and David left some financial information over here as well. Grab whatever you want, wherever you see it. And thank you all very much for coming this evening. Are there any final questions before we close out? Yes, Julie.
Can I throw in?
Please do.
Okay. I'm a local librarian, but I also live in the neighborhood and I go to church here. And I prepared for you all a bibliography. I'm just here to give you tools. It's free. If you don't have a library card, I've got the library card application. This basically gives a list of materials that can help you do what you need to do. And we also have the computers. If you don't have a computer at home, we have a beginning computer class on Monday at 1 o'clock. So if you need help on how to turn it on or whatever you need to do, we can give you that. But these books are available at the library to help you with your projects.
And Julie, I want to thank you very much for having that librarian's mind and coming up with the bibliography. She showed it to me last weekend, and I love it. In fact, I'm down there checking out books myself off of the list. So please feel free to pick that up as well. It'll be here next week too. Thank you all again for coming out, and I hope to see you next Thursday evening.
Thank you.